And it is time for the word on Wall Street. Top investors watching your money. Joining me right now is Mahoney Asset Management CEO Ken Mahoney, Bulltech Capital Markets Chief Strategist Catherine Rudy Vera, and Michael Lee Strategy Founder Michael Lee. Great to see everybody this Monday morning. Thank you so much for being here. So the week has arrived, Federal Reserve meeting. Let's kick things off with you, Ken. We've got a pretty good rally underway. Big week for economic data and the Fed's meeting. It will begin tomorrow. Two-day meeting. We're expecting higher interest rates announced on Wednesday, and the producer price index is out tomorrow. The Dow up 352 right now. What do you make of these moves?
Well, again, this has been telegraphed for about, 9 months that we're going to raise rates a quarter point. Obviously, we're a little bit behind the curve there. This price shift happened last year, but it is what it is. And again, all the focus right now is mostly about oil for all the reasons that we see, these awful images that are happening in Russia and so forth. And the way I look at it is that the last, you're moving about $10 a barrel almost every week. And remember, how's that cut in GDP? Well, each $10 a barrel increase cuts off about 0.5% of GDP. So from $80 to $130 a barrel, that's about a 2.5% off of GDP, which pretty much flatlines us in the first quarter. So, no one wants to talk about the nasty word stagflation, but here we are, very anemic growth and high inflation. And we have an administration that puts its head in the sand around all this stuff. So investors still have a lot to deal with. We had peak GDP, we had peak earnings, and now we have not seen yet peak inflation. So it's a lot for investors to try to handle here.
Well, what about oil, Ken? I know before the war in Ukraine, you were positioned energy and oil sectors to be inflation hedges. Oil pulling back today about 5%. You still want to buy energy here?
No, in fact, we've been selling off incrementally. Very quickly, as you know, we always have reversion to means. Leaders become laggards, laggards become leaders, and that's the same thing here with oil space. So anyone that's buying now is buying more in the 7th or 8th inning, certainly not in the 2nd or 3rd inning like it was last summer.
Michael, we've got record inflation, 40-year highs, surging energy prices, and, of course, this Ukraine-Russia conflict. Many investors are worried about recession as well. What's the impact on the macro story from your standpoint?
Yeah, Maria, great question. So we've only going to see 25 basis points from the Fed this week, but since the Fed started jawboning in September, the 2-year Treasury has gone from 20 basis points up over to 1.8%. Credit spreads, especially over the last couple of months, have increased by 30 to 50%, depending on the credit quality you're looking at. And the Chicago National Financial Conditions Index, the liquidity indicator that I watch closely, has been basically cut in half. So we've already seen a tremendous amount of liquidity leave the market, even though the Fed hasn't raised interest rates, and you haven't really seen any meaningful slowdown in inflation, which means either we're going to see a slowdown in inflation dramatically over the next couple of months, or there's a fair bit of tightening that has to come, maybe not necessarily from the Federal Reserve going from 25 basis points to 3 or 4%, but like I said, on that credit spreads and the 2-year Treasury going up another 50 or 100 basis points, what that all means is multiple contraction across stocks all across the board. Okay, and as that liquidity leaves, I don't necessarily know we're going to see a traditional debt bubble pops, but it's looking like at some point this year we're going to have at least 1 quarter of negative year-over-year GDP growth. If you talk about recession in the sense of that we're going to need 3 consecutive ones and maybe a substantial decline, I don't know that we're going to see that. We're definitely going to teeter on very, very low growth, and this is not good for stocks overall, especially tech stocks that were trading at 30, 40, 50, 100 times earnings. Those multiples are going to come back down to earth. So I respectfully disagree with Ken. I think you've got to own inflation hedges here in the form of consumer staples and energy. I think the supply-demand story in energy is not going anywhere. Hopefully, the Ukraine-Russia tempers down and you lose that short-term catalyst. But that's not going to change. It doesn't look like inflation is tempering at all.
Well, this is the issue, right, Catherine? I mean, you're looking at a Federal Reserve raising interest rates potentially into a slowing economy. We've got the March meeting beginning tomorrow. We're expecting that 0.25 percentage point rate hike, Catherine. But what about that? What about 2 consecutive quarters of negative performance on GDP? That would be a recession, and that would impact earnings. Last week, Stephanie Pomboy told us to expect a profits recession at a minimum. Your thoughts?
Stagflation is our base case scenario. That's a growth at or below potential with high inflation. We're already there. Real growth last year approximated 6% in the U.S. That's massive. This year we're expecting growth to come below 3%. Recession is a real and rising risk, and I think it all depends on oil prices. The higher, I calculate it differently. I have every $25 increase in oil shaves off half a percentage point of U.S. GDP. I expect oil prices to average $125 price per barrel this year. This is going to be probably a long and extended conflict. I see a natural hedge, Maria, between the U.S. Equities market and energy. So if you're going long U.S. S&P 500, you could short the energy market and vice versa. The reason I say that, Maria, is because if things get better, let's say that Russia agrees to some accord with NATO and they're allowed to keep a portion of Ukraine, and sanctions either don't happen or roll back, Russia has no reason to close the Ukrainian pipelines of natural gas, saving energy prices from soaring that much higher, because they could go a lot higher. We could have oil sanctions, natural gas sanctions, and then Russia respond in kind. Oil could go much higher, taking the S&P lower and energy prices higher. There's a natural hedge there. I like energy. I like utility staples and healthcare, because these are both defensive sectors and they outperform historically in stagflationary periods. Recession is a real risk. It's massively underpriced in the markets, and Europe is already in recession. That's my view.
How about the impact from commodities, guys? I mean, do you see a negative impact on the banks as far as what's going on with nickel and other commodities? On Friday, J.P. Morgan said that it is actively unwinding its Russia business, and we find out that J.P. Morgan is the biggest counterparty for nickel and the tycoons' short bets, which created tens of billions of dollars in losses. Any thoughts on banks and what we could see in terms of further fallout from this nickel short bet gone wrong?
I wouldn't be looking at banks here, especially, who are the counterparties. Like, okay, who's swimming naked? We'll find that out very soon. But Maria, more importantly for banks is that yield curve. We start hitting the short-term rates, and long-term rates start coming down to either a flat yield curve or, God forbid, an inverted yield curve. Banks are not going to do it. Banks really like to have a really steep yield curve to be able to profit. So I would not like banks because of the yield curve.
All right, we will leave it there. Catherine Rooney Vera, Michael Lee, great to see you all. Thank you so much. Ken Mahoney, you're sticking with us. We're happy about that. Great word on Wall Street, guys. Thank you. Have a good Monday. Much more ahead this morning.